Hey!
We're Group 1.
And this is our presentation.
All right, let's roll it.
So we're going to start with the current assets portion of our balance sheet. The first item we had is cash and cash equivalents, and we utilized the statement of cash flow to know that this was the beginning balance and this was the ending balance. It was very straightforward. And then for accounts receivable, we had to take two things into account. So first off, in the cash flow statement, there was an outflow. So we added that back to accounts receivable, and then we subtracted the provision for doubtful accounts to become at the net amount for accounts receivable. For inventories, there wasn't a direct inventory line item, so we looked at the other net section of our cash flow statement and noticed that there was an inflow. And so if there's an inflow for inventories, that means that the account or the amount actually decreased, but we got an inflow of cash. And for deferred income taxes, we didn't have any information on the cash flow statement, so we just assumed that those two balances would be the same. And then for prepaid expenses, there was an outflow on the cash flow statement, which means that the ending balance actually increased. And then to arrive at total current assets, we just summed up these two columns.
Okay, so now we're going to move on to our long-term assets, starting with goodwill and other assets. Starting with goodwill, our company actually acquired 3 other companies, and so we decided that we were going to allocate the assets we acquired from those companies to goodwill and then to other assets. The percentages we used were 85% to goodwill and 15% to other assets. And the reason we chose those numbers was because it seems like in the past we have acquired companies and allocated the majority of it to goodwill. So we took 85% of the assets that we acquired and added that to goodwill, and then we took the other 15% and added it to other assets. All right, so now we're going to move on to other intangibles and net property, plant, and equipment. And this was a kind of confusing calculation because on the cash flow statement, depreciation and amortization were actually grouped together. So to determine what allocation we would use for depreciation and amortization, we actually added up the beginning balances of other intangibles and property, plant, and equipment to find what percentage of the total each took up. We then multiplied that by our amount of depreciation and amortization, and to figure out how much would be allocated to each. For other intangibles, we just subtracted the amount of amortization we got to get the ending balance. And for net property, plant, and equipment, we actually had a cash outflow for net property, plant, and equipment on the cash flow statement, which means that we likely bought net property, plant, and equipment. So we added that first, and then we subtracted the depreciation to get the ending balance.
So in the cash flow statement, there was an assumption of debt, so we assumed that they paid off their current maturities. And for accounts payable, there was an increase in the cash flow statements, so we added it back. So in the finance section, there was an outflow of cash dividends, so we assumed that they paid off their dividends. And in cash flow statements for accrued taxes, there was an inflow, so we added it back to the beginning and to get the ending. Accrued interest payable, we saw there was an increase, so we added it back. For other current liabilities, there's a decrease, so we subtracted it. And for total current liabilities, we just added the sum of all of these.
All right, for the long-term debt, we used the extinguishment of debt that we used earlier for the current liabilities. So we had a remainder in that portion of the extinguishment of debt. So we took that, the remainder of the extinguishment of debt, and we threw it into our ending long-term debt. But then there was more long-term debt in the cash flow statement, so therefore it increased. For deferred income taxes, we had an increase of $96.8 million in the cash flow statement. So we took that $96.8 million and we added it to the beginning of this, which gave you that number. For the remainder of the liability section, we had a decrease in other liabilities on the cash flow statement, so therefore we subtracted that portion from the beginning, which gave us the ending. And then for total liabilities, we just did the sum of all of the non-current
So
liabilities.
here is the shareholders' equity section, and we start with the common stock. The beginning balance was 0, and our ending balance is 0, because there was nothing in our statement of cash flows that led us to believe that there was any change in them. Next, we have the treasury stock. The beginning balance was 0, and the ending balance is $121.3 million, because we had an outflow of $121.3 million in the financing section of our statement of cash flows. Next, we have the additional paid-in capital. Our beginning balance was 101.5, and in the reconciliation to net income, there was an increase of 17.4 of stock-based compensation expense. Therefore, we added that to the beginning balance and got our ending balance of 118.9. Next, we have the accumulated other comprehensive loss. This, there was no change in, so we kept it the same. Next, we have our retained earnings. We got our number of 384.5 million because we subtracted the dividends given to us from the net income given to us on the statements of cash flow. And then we have the total shareholders' equity by combining all of these numbers to give us this. And then we have our total liabilities and shareholders' equity right here by combining our total shareholders' equity with all of our liabilities.
Alright, so as you can see, these are the ending balances from our balance sheet, and assets did not equal liabilities plus stockholders' equity, but we do believe that we utilized all the information we were given to the most of our advantage, and we also believe that we acted in accordance with generally accepted accounting principles to the best way we knew how.
Thanks for watching.